We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jesse Felder, founder, editor, and publisher of the FelderReport.com. Jesse, thanks for joining me today.
Always good to talk with you, Tom. Thanks for having me.
Always a pleasure, Jesse. And I think I'd like to start today by asking, if the inflation problem has effectively been addressed at this point, and what data points might show us, let's say, this mirage versus what reality is.
Yeah. Well, I think, the question is, who sees it as a problem, right? Clearly, American citizens see it as a problem, and they should. It's been a painful experience over the past, 3-4 years, really since the inflation took off as a result of, massive money printing. Of course, there were supply chain issues, but, the money printing, played a big role in that. And I think the American people would say it's still a major problem, for them in their lives. Now, it was very interesting for me to hear Jay Powell when asked at the last Fed meeting last week, if you're going to have a period of above target inflation, does it make sense to allow for or to try and get inflation below 2% for a period of time so that it averages to their so-called target? And he very clearly said, no, that is not their intention. And so I think that was very, maybe an underappreciated part of that whole press conference is that, the Fed has a 2% target. In 2021, I believe they changed it to, inflation, average inflation. So at that point, they were saying that, if they have a period of under target inflation, they would shoot to have it above 2% for a period of time so that it averages around 2. But it doesn't work both ways, right? He made that very clear last week that, if they undershoot, they're going to try and overshoot. But if they overshoot, they're not going to try and undershoot. So essentially, 2% now represents a floor for inflation, which is a major, major difference from what we've seen in years past. And so the Fed is telling you, we're targeting 2% inflation, but we really don't want to average 2 for any period of time because we're really not going to let it go below 2. So I think from the Fed standpoint, they're right in line with what they are trying to do, which is we want it close to 2, but we don't really want it below 2. We want 2 and change. And if it goes back up again, we'll do something to kind of bring it back towards 2. We don't really have any desire to kind of really bring it back down so that it's sustainably around 2. And I think so, that's the Fed saying, yes, we've reined in this inflation problem the way we see it. But I think the rest of the world, should look at that and say, okay, this is a Fed that's really cultivating an inflationary environment and doesn't want to do anything to kind of go against that or not be supportive of inflation that can kind of maintain above that level.
Well, I think it's interesting to consider, let's say at what time frame they want to calculate an average of 2% over, if that was, let's say, their goal. And now with 2% being their floor, it seems like, let's say maybe a soft acknowledgement that they have now raised, for all intents and purposes, now raised their inflation target in some ways.
I think
or their acceptable level of inflation, let's say.
Yeah, I think that's absolutely reasonable to conclude that. I mean, as Tom McClellan points out on Twitter all the time, the Fed's legal mandate is 0% inflation. Now they've created this arbitrary 2% target, but now Jay Powell's telling us that they're not trying to average 2. Right. Okay. So then what does the 2% target mean? It means we want to try and bring it down near 2. Right. And as you said, what he mentioned during the press conference was that, okay, on a 3-month annualized basis, we're running in the low 2s. Right. Okay. Well, so now your target is based on 3-month inflation, not 12-month inflation. I thought, this is so they're kind of trying to look at all these different ways of saying, yes, we're very close to target. And the fact that they are willing to basically declare mission accomplished, that they feel very confident that they've done enough to bring inflation back down, and that they're not willing to try and undershoot to it all, is very clear that yes, their idea of the inflation mandate has changed.
Mm-hmm. So of course we got another 25 basis point cut at the November meeting. So considering financial conditions, though, does the Fed really need to be cutting more, or do you think they're reacting to something else that isn't captured by the market conditions, as it were?
I think what Jay Powell's trying to do is he desperately wants to try and pull off the soft landing, right? He as Stan Druckenmiller recently said in an interview that, the Fed's job really shouldn't be to try and micromanage the economy, micromanage the unemployment rate, even micromanage inflation. The Fed's job should really be to prevent us from running into major problems like the great financial crisis, like the housing bubble, like the dot-com bubble, like this big burst of inflation that we've had. And so rather than focusing on preventing these kind of major things, the Fed is very clearly focused on trying to micromanage the economy, inflation, and the unemployment rate in the short run. And that's where they kind of lose sight of these longer run issues. And so I think that that's their big fault right now. Is Jay Powell really desperately wants to try for his own legacy to pull off a soft landing in the economy. So, that means that they don't want the unemployment rate to keep rising, because typically that is a positive feedback loop, right? You start seeing layoffs. So people get worried about losing their jobs, so they start spending less. So economy slows down more, so more people lose their jobs, and it kind of just becomes a vicious cycle. That's exactly what Jay Powell doesn't want on the unemployment side of the mandate. That's why they're cutting interest rates. By the same token, though, it's looking like inflation's kind of bottoming in this, mid to high twos range on core inflation, which is clearly, to my mind, not anywhere near their mandate. As Michael Ashton, an inflation expert that I pay close attention to, has pointed out, median inflation and a lot of these things look like they're settling in a much higher range, in 3 to 4%. And so, that's a problem. But the Fed is trying to thread the needle. Jay Powell desperately, like I said, wants to try and thread the needle where he can feel like he brought inflation down enough, maybe not down to target, but, down well off its highs, and at the same time was able to prevent unemployment from really spiking higher. Now, whether they're able to pull that off is an open question at this point. But I think that's really why they're cutting interest rates right now.
Mm-hmm. Well, going back to, let's say, data points that can maybe show us more of the reality of the situation, what is the bond market telling us about where it thinks inflation is headed at this point?
Well, it's interesting because there's been a big divergence between interest rates and oil prices, over the last several weeks, with interest rates shooting higher without the oil price. Typically, these things are highly correlated because oil is such a big component of inflation, and bonds are typically trying to price inflation risks. So you have the bond market saying it's worried about a resurgence of inflation, is how I interpret it. At the same time, the oil price is saying, it doesn't really see it at this point. So I think that, the other issue, which could explain a disconnect between the two, is just the amount of excess Treasury supply that's going to be coming onto the market with the $2 trillion, annual fiscal deficit. The supply of Treasuries is just growing so rapidly. So that's also kind of an inflationary dynamic. So I think the bond market is telling you that it's potentially the bond market vigilantes are starting to stir, starting to say, hey, we're worried about the amount of debt. We're worried about a Fed that maybe is not as committed to reining in inflation. And maybe there's just not enough term premium in the bond market to compensate for those risks.
Mm-hmm. So, you pointed out earlier that you think the bond market has basically bottomed, possibly in this mid to high twos. What do you see as the possible path forward for inflation? Do we get something like let's say, the triple higher highs of the 1970s?
In terms of inflation, yeah, I mean, I think we probably are in a time period where we will see inflation cycles, right? Where we'll see and probably will closely respond just like it did in the 70s to monetary policy. So Fed was way too easy in 2020 and 2021, and that allowed for inflation to kind of go out of control to the upside. I think it's very easy to argue today that the Fed is once again, too easy or not paying enough attention to the inflation side of the mandate. And so that leaves the door open to another resurgence of inflation. Especially if we get, a bunch of tariffs, especially if, geopolitical stuff continues to heat up and oil prices do begin to rise again. There's a lot of potential things out there that could stoke in a resurgence in inflation. So I do think we are in an era where we're going to see bouts of inflation that kind of go along with the monetary cycle. And so Fed easing today opens the door to another bout of inflation over the next 6 to 18 months.
Well, you bring up an interesting point, and that's this idea of tariffs and tax cuts. Let's say that Trump has promised. How long would it really take for any of those promises to actually be seen back in the fiscal side of the equation in the economy?
I mean, that's a good question, right? There's a lot of, it's an open question as to, how much was just campaign rhetoric? How much actually, is going to be implemented? How much does Congress need to be involved in that implementation, and how willing is Congress to, go along with it, right? I mean, we did see a red wave. So, there's a good possibility that a lot of it could get passed. I think one concern that I have, and I think maybe, markets aren't discounting enough, is the potential for a Liz Truss type of moment in the bond market. So, you get proposed tariffs and tax cuts and these types of things. The bond market could easily kind of do what it did in the UK and start to spike on the long end and say, and the markets start to, especially with the Fed continuing quantitative tightening right now and reserves running down and all these things, we're kind of heading towards, a lot of these things are setting up to see a potential revolt in the bond market. It's something that a lot of people have warned about for a long time. I know that Warren Buffett and Stan Druckenmiller have avoided owning long-term treasuries for this very reason. Bill Dudley, former head of the New York Fed, has spent this whole year warning about the potential for, problems in the bond market related to that. So if you have a $2 trillion fiscal deficit, and then you're talking about cutting taxes in a significant way on top of that, during an economic expansion, you might see the bond markets, bond market vigilantes start to say, "Hey, hold on, this is not a workable scenario." So, you could have something like that even happens before the inflationary impacts are allowed of those policies are allowed to kind of even move forward. And so that's something that I would kind of be keeping a close eye on going forward.
So between these let's say the market expectations or the market conditions, the possible bond market revolt, are we poised to possibly get another lost decade here if you're still invested in bonds and the stock market?
Yeah, I think, tips look pretty interesting to me, and tips and the gold price move pretty close together. I think typically, and I've been on this bandwagon for several years now, is that real assets look very compelling relative to financial ones. Just the macro setup, the setup with the fiscal situation. All of these things point to it making a great deal of sense to protect yourself with assets that are very scarce in terms of supply, and cannot be manufactured in any way like financial assets can. I mean, you can always go issue more stock, you can always go sell more bonds. And that's what we're seeing is the supply of financial assets continues to grow. And you cannot grow the supply of, a lot of different commodities and things without investing heavily. We haven't invested in those things. They're dramatically undervalued relative to financial assets too. So yeah, I do think we are, this period over the last several years represents a major tidal shift, a regime change, whatever you want to call it, where the outperformance of financial assets, stocks and bonds, has lasted for 15 years, and real assets are starting to outperform in a very material way. From 21 to 23, we saw energy stocks were the best. I mean, they're still the best performing sector of the stock market, even though this year's been difficult. The gold price has done better than the stock market this year, and has done phenomenally well over the last number of years. And so I think we're still in the early innings of that transition, and part of that is due to the change in the macro environment, but also part of it is just due to valuations, right? Financial assets are significantly overvalued. Like I said, there's not much term premium in the bond market. Historically, we've seen the average, term premium significantly higher than it is today, and that's even in an environment, a disinflationary environment. I would argue, in a new inflation regime, the term premium should be significantly higher on bonds. And now you have the stock market is the most overvalued it's literally ever been in history. If you look at things like the Buffett yardstick, or normalize valuations for profit margins, extreme profit margins, we're more overvalued today than in 2000, the top in 1929. Even on a forward PE, if you just look at forward price to earnings ratio, we're right at basically where we were at the peak in 2021 and nearly as high as we were in 2000. So stocks are extremely expensive, and the price you pay determines your rate of return. Paying high prices means you're necessarily, by definition, going to get a lower rate of return going forward. So I think generally, we could very easily have a lost decade for 60-40 portfolios, stock bond portfolios over the next 10 years.
You mentioned tips and also Warren Buffett in there. Do you think he's really acknowledging the same reality by buying or having the highest cash position ever in Berkshire Hathaway? That seems like a very defensive play to me.
It absolutely is. I mean, if you look at it, it's $325 billion in cash, which is obviously the biggest in nominal terms that Berkshire Hathaway's ever had, but it's also the largest relative to the total asset, Berkshire's total assets. So this is essentially, he's never had more cash as a percentage of the portfolio than he does today. So yeah, and I think it's very important to also point out, all of that cash is not invested in treasury bonds. It's invested in bills. Very short-term, 3-6 month, T-bills. Why is that? I mean, historically, you look back in the late 1990s, the last time, when Berkshire was building a cash position, then even in 2007, was the last time Berkshire had a cash position anywhere close to what it has today. And he was buying, bonds. He was going out and buying duration. In the late 90s, he was buying zero coupon bonds. He was essentially making a big bet that interest rates were going to come down. Mm-hmm. He's not doing that today. He's staying on the short end of the yield curve. Clearly, he's worried, and I think he's written about this in the last annual letter. He's worried about, do I want to take all this duration risk at a time when the fiscal situation is potentially running out of control? And so not only is he extremely cautious towards the stock market by building cash, he's extremely cautious towards the bond market, doesn't want to own anything bonds of any significant duration at all. So you could say, relative to financial assets, he's never been this cautious in his, half century long career, 60-year career.
Mm-hmm. Do you think it's possible that he's, maybe getting ready to shut down his successful firm if the markets continue to get even frothier from here?
I don't think they will ever shut Berkshire Hathaway down. I mean, he's named a couple of successors. He's got Todd and Ted, who are basically the portfolio managers now. And he's got CEOs running the individual companies. So I do think he's basically set this up to be a very long-term business. They might pay out a dividend or something along those lines. But I do think the building up of cash is what he's always used it for. Like in 2005, he built up a pretty big cash position and put that to work in 2008 and 2009 when he had terrific opportunities to buy things on the cheap. And I think that's exactly what he's trying to do this time. He wouldn't call it market timing, but what he would say is when the equity market offers you, when treasury bills offer you 5% risk-free rate of return, and the equity market's not going to offer you, anything better than that, then it's only, it only makes sense to keep your money in cash, earning, risk-free, 4% and change, and wait for those opportunities to put that money to work when you can, have potential returns. You can reasonably expect returns to outperform that risk-free cash rate. You just, can't today. In fact, if you look at some of the best, my friend John Hushman has put together the single best measure of, forecasting long-term returns over a 10-year period, 12-year period. And it's a measure that's very similar to the Buffett yardstick, essentially kind of a price to sales measure. And right now it's forecasting negative annual returns over the next 10 years. So, when you look at that, and even the Buffett yardstick is telling you you're probably going to lose 3, 4, 5% a year owning the S&P 500, and I can get 3, 4, 5% in T-bills. On the positive side, it's a no-brainer to just build up the cash position. And that's exactly what Buffett said at the last annual meeting, is we don't have any problem building up the cash position when equity valuations are so rich and cash pays us so much.
Mm-hmm. Well, the reason I asked that was because I had read an article that was saying that at one point he just didn't like the market so much that he basically, it's not that he closed, but he basically shut the doors to new investment just because of the frothiness of the markets. Yeah,
actually, that was back in the 60s. He had essentially a hedge fund. It was one of the early hedge funds. It was a partnership, but it had a performance fee on it. So it was very much like a hedge fund. And what he did at the time was in 69-ish. I think he basically couldn't find anything to invest in. So he returned all the cash to his limited partners, except for that cash that was invested in Berkshire Hathaway. And so, that became the investment at that point. But he did basically shut down his hedge fund in 1969 and really just kind of close it down to just Berkshire. Became the one investment. So he's done that in the past where he's said markets are too frothy. It's time to step back and he wrote about it in 1999 and 2001 in Fortune magazine that, hey, look, I don't want to sell my Coca-Cola. This is something I want to own for forever. But it probably doesn't make sense to be too heavily invested in equities at the moment. Mm-hmm. So I think he's at that same place today.
So because of that yield, Jesse, is that why he doesn't, or the yield that he's getting on the cash, is that why he doesn't like gold, because it doesn't offer that same type of coupon?
I think so, but that's not deterred him in the past. Mm-hmm. There are times when Buffett has bought a bunch of silver. Actually, in the late 90s, he bought a lot of silver. There's been times in the 60s, kind of, he did the same thing when he was basically anticipating that the the way that the federal government was going was inevitably going to debase the currency. It makes sense to own those types of things. Now, I think it's very, very difficult for Berkshire Hathaway's size to kind of make any commitments at all in the precious metals space. And so I think that's probably the biggest reason why he stays away is like, he literally, when you have 300 plus billion in cash to put to work, it's very difficult to find opportunities. I mean, there are a lot of Fortune 500 companies he would have to buy entirely in order to kind of make any dent in his performance going forward. So I think he's just too big now to kind of play in certain markets.
Mm-hmm. When I was reading about that in preparation for today, I was wondering if most people should not be really paying attention to the lessons from Warren Buffett because of his firm's size, because of his firm's allocations. This puts him in a very different place, does it not?
It does. Yeah, absolutely. But I think that the underlying philosophy behind what he does is probably one of the most important things for individual investors to pay attention to. I think one of the I guess themes or driving forces behind investing today is especially misguided, and that's buy equities regardless of the valuation, right? That's what passive investing, putting your money into passive funds and set it and forget it, this type of attitude necessarily means there are going to be times when you are paying uneconomic prices, right? I'm going to be buying stocks. Like I said today, if you were to use the Buffett yardstick to forecast returns, you look at very likely going to see negative returns annually over the next, average annually over the next 10 years. That would, as any basic investing methodology would teach you, why would I want to commit capital to something that is likely to generate negative returns? It's almost like buying a bond with a negative yield, right? Like we had a few years ago, back in 2020, 2021, there were a lot of bonds that had negative interest rates. Okay, well that makes no sense. Why would I buy those things? So I think to kind of say that type of price sensitivity, valuation sensitivity is something that investors should ignore. I would disagree with that, but I do agree with the sentiment that there are more opportunities available to individual investors and more things that potentially that are not at Buffett's fingertips. Like I said, Warren Buffett can't really play in the precious metal space. He can't play in small caps. He can't play in a lot of these different things because he's just too big. Those areas are open to individual investors who maybe see the relative value in small caps today, who maybe see that yes, it makes sense to have an allocation to precious metals and these types of things, even if Warren Buffett can't do those things anymore.
Mm-hmm. Of course, since the election, we've seen gold and silver go down a reasonable amount here. Do you think that this is basically the war premium portion of the gold trade coming out of the precious metals?
I don't know if it's the war premium. Several weeks ago, I took down my precious metals exposure because for a few reasons. One, the monetary cycle has been a very clear pattern driving the gold price this cycle and the previous cycle. And when you overlay, you look at that as like an analog, a price analog. You go back and look at that, 2016, 17 to 2021 cycle in the gold price. And we've essentially relived that over the last 3-4 years, where you had in 2017, 18, Jay Powell raising interest rates, gold price consolidating, gold price breaks out in anticipation of the Powell pivot in late 2018. And from that point, Fed is on an easing path. we get the repo crisis in 2019, and then COVID hits, and gold, shoots higher into the summer of 2020, and then peaks. And right, we had a long consolidation from 2020 to basically 2023, 3 years of sideways action in the gold price. Now, we had a very similar experience over the last few years where, gold prices, like I said, peaked in 2020. Then we're trading sideways until 2023-ish, when markets started to the gold price started to anticipate another Powell pivot, right? Mm-hmm. So Powell said, we're pretty much done hiking interest rates, and gold prices screamed higher. We get a couple of rate cuts. Gold prices basically did again what they've did in 2020. If you look at that pattern, it's a very, gold price has responded almost exactly, over the last few years as it did to the previous monetary cycle. So that would suggest that, based on just that analog, that this spike that we've seen is very similar to the 2020 spike. It's also, from a technical standpoint, we had that period that I mentioned, that 2020 to 2023 was a very clear bullish flag pattern, in terms of technical analysis over that time period. So you had gold price run up, consolidate, and run up again. And both of those run-ups were almost exactly $750 in price. And it was almost a perfectly, parallel move. And so that would tell me that, you had the run up, you had a flag, and then the projected target after that bull flag would be essentially, that's technical analysis 101. You take that 750 price move, say gold should probably go up $750 after breaking out. It did exactly that. So it fulfilled the technical target. It also fulfilled that monetary cycle target. And we also saw managed money in the Commitment of Traders report get extremely bullish, essentially kind of overcrowded positioning in terms of at least in the futures market. So kind of all those things, to me said, okay, the move might be over for a little while. That's not to say that I'm bearish at all. I still have a sizable, gold position, and I think that we're in a longer term bull market. But this cycle of the gold bull market might have run its course for a time, and we might be in for another period of consolidation.
Mm-hmm. So, Jesse, you've mentioned basically the over exuberance of let's say the general stock markets here. Does this really make any sense as let's say a reaction to Trump's election? And is it possible that this is basically just being driven by momentum buyers, which could show us a steep, waterfall on the other side of this?
Yeah, there's a bunch of indicators that I look at that are all kind of pointing, in addition to valuations, right? Valuations, as I mentioned, are as extreme as they've ever been in history. But, valuations aren't a timing tool. Mm-hmm. And so, I use other types of indicators to help in that process. And one of those is, just looking at momentum and trend exhaustion indicators. I use DeMark indicators. DeMark sequential and DeMark combo are two indicators. We literally this month had a new DeMark 13 trend exhaustion sell signal on a monthly time frame in the S&P 500. We've had several in the NASDAQ as well that suggest that the longer term trend is vulnerable to a reversal. The last, couple 13s that we've gotten have marked kind of the end of the uptrend for the S&P 500. We had one kind of in late 2021, was the last one before this one we just got. And we had one also in late 2017, right before Volmageddon. And obviously some might remember the late 2018 sell-off that we had in the stock market. That period after the last couple of DeMark monthly combo sell signals has been a very good kind of indicator of potential reversal in the longer term trend. At the same time, we've had a ton. The breadth has been terrible. The way that I measure it. So you can look at, Hindenburg omens and Titanic syndromes. These are basically indicators that trigger when the market is at an all-time high and you have the number of new lows are growing. So basically it's a sign of lagging participation. And every time we've seen the number of Titanic syndromes cross above 50 over a trailing 12-month period, it's always, kind of rhymed with these DeMark trend exhaustion signals. So, we just hit, I think, 53 Titanic syndromes over the last 12 months. On the NASDAQ, we've hit an all-time record. We've had 43 Titanic syndromes in the NASDAQ over the last 12 months. I mean, we only literally had like 27 at the peak of the dot-com bubble. We had 30 in 2007. We have 43 Titanic syndromes in the NASDAQ over the last 12 months. That's literally the loudest screaming breath warning, on record. Mm-hmm. And at the same time, I think, I would just finally point out that insiders, the insider sell to buy ratio, something I watch very closely. And insiders have been just about as bearish as individual investors have, and institutional investors have been bullish. So you have, bullish positioning by retail investors, by institutions is just off the charts bullish. Insiders have almost never been as bearish as they are today. There's almost no buying on the part of insiders. Literally, it's the least amount of buying we've seen since 2012. Mm-hmm. And at the same time, you see massive selling. So you saw, Jensen Huang has sold, a ton of NVIDIA stock. Jeff Bezos has sold, I think, close to $13 billion worth of Amazon stock this year. In 2021, he only sold like $5-6 billion in Amazon, and that was really good timing before the 2022 bear market. Bezos sold almost 3 times as much stock this year as he did in 21. So there's just tons of evidence that insiders generally are using the strength to take money off the table, and there's just almost no buying interest at all. So you put all those things together, and to me, they're all kind of just scream, it's time to be cautious. And then from that perspective, I just understand why Warren Buffett is literally positioned more cautiously than he's ever been in his career.
Mm-hmm. So, Jesse, how do you think investors avoid a lost decade, at very least, if that's what is to occur again?
Well, I think most investors should probably use some type of asset allocation model where they can scale exposure. Maybe they don't sell all their stocks and go to cash, but you could scale back your equity exposure and say, it does make sense to own more cash. And then in terms of that cash exposure, I don't really want to own long-term bonds. I want to stay on the short end of the yield curve. And I also want to make sure I have a healthy allocation to real assets. And so that would be precious metals. And I think energy stocks right now are just very, very compelling. I think I would just point out too, I think I'm not exactly sure what Berkshire Hathaway's allocation to energy is today, but the S&P 500 has about a 2.5% allocation to energy. And I know that Buffett has at least 4 times as much money allocated to energy. So that's a massive overweight. And that's Occidental Petroleum, and I think Chevron, is another big position of his. So, I think energy is compelling. I think it makes sense from an asset allocation standpoint to scale back your exposure to equities, to long-term bonds, have more cash that is yielding a nice amount today, and make sure you have enough exposure to real assets, to commodities, energy stocks, precious metals, tips, these types of things.
Mm-hmm. With the stock markets at these lofty levels, it makes these ratio charts, like for example, of emerging markets versus U.S. stocks or U.S. stocks versus commodity producers, makes them look so dramatic. Is this another, let's say, good way to start looking for sectors that could at very least just revert to the mean?
For me, the way that I look for those things is I come back to the insider activity. Mm-hmm. I've seen any of the insider buying that I've seen over the last few years has been in the small cap space, or it's been in the energy space. Mm-hmm. And so those to me are relatively compelling. If I'm going to have equity exposure, I want to skew it towards small caps, and I want to skew it towards energy, because that's where I've seen I mean, for example, Heartland Express is a small cap trucking company where the owner, second generation owner of the company has been just buying tons of stock. There's been, and energy stocks too that have had significant buying. A lot of it's just been, billionaires like Jerry Jones buying Comstock Resources, or, Buffett buying Occidental, or, Carlos Slim buying PBF Energy. To me, it's very clear the smart money, where the smart money is putting money to work. And that's kind of where I'd want to kind of skew my equity exposure.
Mm-hmm. Jesse, you've talked or you've mentioned energy stocks quite a bit here. Is that only, let's say, oil and gas to you? Is that midstream producers? And, with this rise of AI, with the rise of needing nuclear energy power centers to really supply all the power for these bigger AI centers, is that something you're starting to look into or dabble in?
Not really. The rally that we've seen in utility stocks as part of the AI thing is, to me, just a sign of kind of too much animal spirits, too much euphoria in the space. So I've kind of avoided the utilities sector. Generally, I am primarily focused on oil and gas, and I think that's because if you do believe that inflation 2% is now a floor for the Fed's inflation, I think it's, and you just look at the chart, right? Look at the chart of interest rates, right? Very clearly we have a bottom in 2020, 2021, and we're in a pattern of probably higher highs and higher lows, going from downtrend to uptrend in interest rates. 2% you can now think of as a floor in inflation. I look at the oil price and I see a very similar thing. As I mentioned before, interest rates and oil prices, inflation, they all kind of are all tied together. And for the last, up to 2020, $70 was really kind of a ceiling for the oil price for after the 2016, 2014, 15, 16, oil price crash. We kind of had a $70 ceiling in the oil price. And I think $70 is probably now a floor. Mm-hmm. And if that's the case, then it changes the whole dynamic of investing in these stocks. And why I say that, as a floor, is just the supply-demand dynamic is changing, where demand keeps hitting records. We're not investing in supplies at all. The whole ESG boom really put a damper on investing in the space. And so the supply-demand dynamics, I think, are very bullish going forward, just from that standpoint. And, Biden, draining the Strategic Petroleum Reserve really helped kind of cap oil prices over the last few years. But now, I think the prospect going forward is, okay, we're going to be looking to kind of refill that, because with all the geopolitical tension out there, we can't afford to not have a Strategic Petroleum Reserve, and it's about as low as anybody would ever want it to be. Mm-hmm. So, if you get under $70, you're going to start saying, okay, let's start filling that Strategic Petroleum Reserve, and these types of things happen. China starts to say, we're going to stockpile oil. So I think from that standpoint, I have switched my mindset for thinking, okay, 2% is now a floor in inflation. Interest rates now on a period of higher highs, higher lows. $70 now a floor for the oil price. In that environment, that's dramatically different than what we got used to over the 10 years prior to the pandemic. And it's a paradigm shift that I can't emphasize enough. Just how important it is, and it as I said, it makes the case for investing in energy producers that much more compelling to have that type of a floor underneath rather than a ceiling on your key production commodity.
Right, Jesse. It's been brought up on the show before that really when the SPR was, let's say, built and at its biggest capacity, we didn't have nearly the production that we domestically do now. So it's been argued that we don't need that same capacity just kind of sitting around. Is that something that you see as a reasonable argument against going back to those lofty levels that we did have at one time?
No, I don't see that as a valid argument, because the type of oil that we produce, we ship overseas because it's not the type of oil that we typically use here in the United States. So we ship over light sweet crude, and that's typically what we refine in here and use here in the United States. And so that's typically what we would probably want to keep in the Strategic Petroleum Reserve, not the type of oil that we're producing from shale, from fracking, and these types of things. So that it's not really kind of a one for one. By the same token, those shale wells deplete so much quicker than for example, kind of Saudi's oil reserves. And so, there's a case to be made that yes, we have a lot of production, but we're not producing the type of oil that we need in this country, and the depletion is so much quicker from those wells that it's probably not it's not equivalent at all to having a strategic petroleum reserve. And so, especially because the oil, it also affects how those oil companies want to produce it too. So you look at companies and, that are producing it, and they're saying, we're not going to drill it when it's not economic. And so, they're going to try and, I think, the fact that they're being so careful with, drilling a lot of these things right now tells you just how worried they are about the depletion. And, my friends at Gehring and Rosenzweig pointed out that a lot of these major drilling areas could hit peak production a lot sooner than people anticipate. And so that would put, an important it would be an important shift for the supply dynamic, that how people see it as, supply is aplenty today. They potentially are not as plenty as the markets potentially are anticipating today. If that depletion is quicker than anticipated. So, I don't think it's safe to say we don't need the SPR any longer now that we're producing so much, simply, for those reasons.
Mm-hmm. Man, just thinking through the consequences of that, if and when we do end up in a higher inflationary environment, combined with a sooner than expected, let's say, peak oil scenario in the US, that would create just, a terrible storm for inflation. Do you have any indication on, as you said, when that type of peaking could hit the U.S. markets?
I just have to clarify, I am no expert. I rely on the experts to kind of keep an eye on this sort of stuff. As I pointed out, I really rely on, I really like the work that GNR does, Gehring and Rosenzweig, and I've been talking to those guys for a few years now. They seem to have a much less sanguine perspective on the length of those and those reserves, and in a lot of the shale basins. So I think that it all depends on, markets right now, I think, are pricing oil as if supplies are overabundant and demand is waning, either for economic reasons as part of recession, or because the transition to alternative electric vehicles and these types of things is going to really impede the demand for fossil fuels. I think it's a very easy case to be made that kind of both sides of those equation may be wrong, that supplies are not as abundant as markets believe, and that demand is going to remain more robust than markets are currently pricing in. I think that's probably why this billionaire class of Carlos Slim, Warren Buffett, Jerry Jones are investing so heavily in the space, because it's mispriced for those reasons.
Mm-hmm. Interesting. Well, so many things as usual to try to keep abreast of, Jesse, and I really appreciate you filling us in on some of those. Is there anything you'd like to leave our listeners with here today to think about before we wrap up here?
I think I would just, leave people with the thought of, about the equity market. That's my major focus. if I had any area of expertise at all, it's probably in equities. Although I've been wrong this year on terms of the overall direction. But I do think that people should not discount the message from Buffett raising cash to these levels, discount the message from insiders positioning about as conservatively as Buffett. Those are very clear signals that at least from an insider standpoint, that buy-sell ratio is perhaps the best leading indicator of the economy, earnings, and stock prices that I've seen in my career. Right now, insiders are saying that earnings are likely to disappoint, the economy is likely to disappoint, and stock prices are going to reflect that probably over the next year. And given the fact that valuations are so extreme, with that potential disappointment on the horizon, I think it makes a great deal of sense to be about as cautious as your own discipline will allow.
Mm-hmm. Well, I certainly find it hard to argue with those arguments, Jesse. And I think all of those indicators that you mentioned really paint that picture extremely well. Of course, all of Jesse's work available at thefelderreport.com, FELDER, and at Jesse, 2 S's, 1 E, at Jesse Felder on Twitter. Jesse, thanks so much for your time today. Really appreciate it.
Hey, thanks, Tom. Always fun to talk with you. Appreciate it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.